Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Asymchem Laboratories, Tianjin Co. Limited, Annual Report. Asymchem Laboratories, Tianjin Co. Limited, offers a wide range of businesses and services to cater to the needs of pharmaceutical and biotechnology companies. At the forefront of their offerings are API solutions, which include small molecules, highly potent compounds, carbapenoms, glycans, peptides, oligonucleotides, and therapeutic enzymes. The company's capabilities extend beyond API solutions to encompass various manufacturing processes such as GMP and non-GMP commercial manufacturing, clinical manufacturing, separations, crystallization, fermentation, and continuous flow. Additionally, they provide chemical process R&D, analytical services, regulatory support, preclinical R&D assistance, PPQ readiness, and back integration services. Asymchem Laboratories also offers technology services that leverage cutting-edge technologies such as flow chemistry, biocatalysis, fermentation, chiral synthesis, hazardous reactions, low-temperature processing, non-precious metal catalysis, NPMC, high-pressure chemistry, electrochemistry, and photochemistry. Furthermore, the company provides drug product solutions including pharma solutions, preformulation, solid oral dosage, and injectables. In the realm of biotechnology, Asymchem Laboratories offers biotech solutions encompassing drug substance development, consultation services, and support for pharmaceutical companies. With a strong foundation established in 1998, the company has become a trusted partner for pharmaceutical and biotechnology companies seeking comprehensive solutions for their API and drug product needs. Asymchem Laboratories, Tianjin Co. Limited, maintains a market capitalization of $44 billion, broadly in line with the industry peer group. Asymchem Laboratories, Tianjin Co. Limited, trades at a higher price-to-earnings ratio of 28 times and a lower price-to-book ratio of 1.69 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 13% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth in a company can be attributed to several key factors. Firstly, expansion into new markets, such as Europe, has contributed significantly to revenue growth. Additionally, overseas customers have shown a 14.85% year-on-year growth, while domestic customers have experienced a 15.09% year-on-year growth. The emergence of new businesses, including the chemical macromolecule CDMO business and biological macromolecule CDMO business, has also driven revenue growth, with increases of 123.72% and 95.76%, respectively. Furthermore, the development of top-tier technology platforms, obtaining authorized patents, and focus on R&D have all contributed to revenue growth. In terms of specific business segments, the Clinical Research Organization, CRO service business, has seen a 26.53% year-on-year revenue growth, while the drug product CDMO business has experienced an 18.44% year-on-year revenue growth. The company's ability to publish research papers in leading international journals and its focus on emerging business have also driven revenue growth. On the other hand, the primary drivers of revenue decline are largely external factors, including uncertainties in global trade and policy. Additionally, a decrease in overseas revenue by 15.3% has contributed to revenue decline. Net income experienced significant growth over the past year, with a notable increase of 56.09% from RM 253,000 488,000 in 2024 to bone million, 253,488,000 in 2025. This substantial rise is evident across multiple reports, including pages 13 and 22. The net income also saw an increase of 19.35% to bone million, 132,570,000. The profit margins also underwent notable changes. The gross profit margin increased by 0.56 percentage points to 41.59%, while the net profit margin attributable to shareholders rose by 0.63 percentage points to 16.98%. Furthermore, the non-IFRS adjusted net profit margin saw a significant increase of 4.96 percentage points to 18.79%. The gross profit margin of emerging businesses also experienced a notable rise of 8.47 percentage points to 29.65%. The reasons behind these changes are not explicitly stated in the provided text, but it can be inferred that the company's financial performance has improved significantly over the past year. This could be due to various factors, such as increased revenue, cost-cutting measures, or strategic business decisions. The company's financial performance has shown a promising trend in recent years. One key indicator of this success is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various expenses. According to the data provided, both 2024 and 2025 have seen positive operating cash flows. This consistency suggests a stable financial foundation for the company. The ability to consistently generate positive cash flow indicates that the company's business model is effective in producing revenue that exceeds operational costs. The performance of various segments and regions in the industry is a mixed bag. Europe stands out as one of the top-performing areas, along with specific business segments such as peptides, oligonucleotides, and ADCs growth businesses. In terms of contract development and manufacturing organization, CDMO services, both chemical macromolecule and biological macromolecule CDMO businesses have shown strong performance. The drug product CDMO business and clinical research organization, CRO service business have also performed well, particularly in overseas markets. The industry has seen growth from various types of companies, including global pharmaceutical companies, small to mid-size pharmaceutical companies, biotechnology companies, and emerging services providers. Additionally, specific areas such as peptide commercial production, oligonucleotide production, and biological macromolecule CDMO business have shown promising results. Overall, the performance of these segments and regions suggests a diverse and thriving industry with opportunities for growth across various sectors. Management's outlook for the company is optimistic, with a focus on future growth. They plan to allocate increased expenses towards research and development (R&D) to provide a one-stop solution platform, anticipating revenue growth as a result. To achieve this goal, management has outlined several key strategies. These include expanding overseas capacity, strengthening international presence, optimizing supply chain operations, and focusing on talent management through employee training and recruitment of experts. The company is confident in its ability to continue profit growth, citing sufficient liquidity and an increase in revenue as key drivers of growth. However, management acknowledges the pressure on margins due to the strengthening renminbi against the US dollar, but plans to mitigate this risk through foreign exchange contracts. Ultimately, Asymchem aims to become a reliable partner for the global pharmaceutical industry by capturing the growing trend of contract development and manufacturing outsourcing, CDMO, in China. By advancing market leadership in small molecule CDMO and driving growth through emerging business lines, the company seeks to establish itself as a leader in its field. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would be worth mentioning. This suggests a stable and consistent approach to business operations, with no major changes in the company's portfolio or structure. The company has a history of distributing profits to its shareholders through various means. One way it achieves this is by paying dividends. According to the provided information, the company has proposed a final dividend of bone 0.3 per ordinary share on page 63. Furthermore, on page 51, it is stated that the company has paid dividends as part of its 2025 profit distribution plan. In addition to paying dividends, the company also engages in share buybacks. On page 33, it is mentioned that a total of 12,300,701 shares have been repurchased by the company. This indicates that the company has utilized its resources to purchase back a significant number of its outstanding shares from the market. Concerns about inventory buildup and supply chain disruption are mounting. The data reveals a significant increase in order backlogs across various business segments. Specifically, the chemical macromolecule CDMO business saw a staggering surge of 127.59%, while the biological macromolecule CDMO business experienced an increase of 55.56%. These elevated order backlogs are not limited to domestic orders alone, as overseas orders also accounted for a substantial percentage in both businesses. Furthermore, the rising cost of sales by 13% from 2024 to 2025 is a telling indicator that inventory buildup may be on the horizon. This increase in costs could signal potential issues with supply chain management and inventory control. The combination of these factors raises concerns about the company's ability to manage its inventory levels and maintain a smooth supply chain, potentially leading to disruptions down the line. That concludes the financial summary for Asymchem Laboratories, Tianjin Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.